Wells Fargo was founded in 1852 by Henry Wells and William Fargo, two pioneers in the banking industry. Originally established as a stagecoach company, Wells Fargo quickly expanded into banking and became one of the largest financial institutions in the United States. Over the years, Wells Fargo developed a reputation as a trusted and respected institution, known for its commitment to customer service and community involvement. For many years, Wells Fargo was seen as a model of integrity and ethical behavior in the banking industry. The bank's strong focus on customer service and community involvement helped to build its reputation as a reliable and trustworthy institution. However, as we will see, this reputation was not always deserved. The first scandal: fake accounts. In 2016, it was revealed that Wells Fargo had created millions of fake accounts in order to meet sales targets and earn bonuses. The scandal was the result of a highly aggressive sales culture that encouraged employees to open new accounts for customers, even if the customers did not want them. In many cases, employees forged customer signatures in order to open the accounts without their knowledge or consent. The scandal was a major blow to Wells Fargo's reputation, as it revealed a systemic pattern of unethical behavior within the bank. The bank was fined $185 million by the Consumer Financial Protection Bureau, and several top executives, including CEO John Stumpf, were forced to resign. In addition to the fine, Wells Fargo had to pay out millions of dollars in compensation to customers who had been affected by the fake accounts. The scandal led to a significant loss of trust in the bank, and many customers began to move their accounts to other institutions. The second scandal: forced auto insurance. In 2017, Wells Fargo was hit with another scandal when it was revealed that the bank had been charging customers for unnecessary auto insurance. The scandal involved around 570,000 customers who had taken out auto loans with the bank. Wells Fargo had required these customers to purchase auto insurance as a condition of their loans, even if they already had insurance coverage. The forced insurance was often more expensive than the customer's existing coverage, and many customers were not even aware that they had been charged for it. The scandal resulted in millions of dollars in refunds to affected customers, as well as a $1 billion fine from regulators. The forced insurance scandal was another blow to Wells Fargo's reputation, as it revealed a pattern of predatory behavior towards customers. The bank had placed its own profits above the financial well-being of its customers, and many customers once again began to question whether they could trust the institution. The third scandal: mortgage fraud. In 2018, Wells Fargo was hit with yet another scandal when it was revealed that the bank had been engaging in mortgage fraud. The scandal involved the bank's mortgage division, which had been falsifying income documents in order to approve loans that would otherwise have been denied. The fraud was a major violation of the bank's ethical standards, as it involved deliberately deceiving customers and regulators in order to make more money. The scandal was yet another blow to Wells Fargo's reputation, and the bank was forced to pay out millions of dollars in compensation to affected customers. The scandal led to the resignation of several top executives, including CEO Tim Sloan, who had been brought in to clean up the bank's image after the previous scandals. However, despite the leadership shakeup, many customers and investors remain skeptical about whether Wells Fargo could ever regain their trust. The aftermath of the scandals. The scandals at Wells Fargo have had a significant impact on the bank's reputation and financial performance. The bank has been hit with billions of dollars in fines, and its stock price has suffered as a result of the negative publicity. In addition, many customers have moved their accounts to other institutions, and the bank has struggled to attract new customers as a result. The scandals have also had an impact on the broader banking industry, as they have raised concerns about the culture of greed and unethical behavior that can exist within financial institutions. Many experts have called for stronger regulations and oversight to prevent future scandals from occurring. The impact on Wells Fargo's reputation. The scandals at Wells Fargo have had a significant impact on the bank's reputation. The bank was once seen as a model of integrity and ethical behavior, but the scandals have revealed a darker side to the institution. Many customers and investors have lost trust in the bank, and the scandals have damaged the bank's brand and image. The scandals have also had an impact on the bank's employees, many of whom have expressed frustration and disillusionment with the bank's leadership. The bank has struggled to retain top talent as a result of the negative publicity, and many employees have left the institution in search of more ethical and trustworthy employers. The legal consequences. The scandals at Wells Fargo have led to significant legal consequences for the bank. The bank has been hit with billions of dollars in fines, and several top executives have been forced to resign. In addition, the bank has had to pay out millions of dollars in compensation to affected customers. The legal consequences of the scandals have sent a strong message to the banking industry that unethical behavior will not be tolerated. However, some critics have argued that the fines and other penalties are not enough to deter future unethical behavior, and that more needs to be done to hold financial institutions accountable for their actions. What Wells Fargo is doing to regain trust. In the wake of the scandals, Wells Fargo has taken a number of steps to try to regain the trust of its customers and investors. The bank has implemented a number of reforms aimed at improving its ethical standards and customer service, including appointing a new CEO, Charlie Scharf, to lead the bank, implementing a new code of ethics for its employees, increasing its focus on customer service and satisfaction, investing in new technology and infrastructure to improve its operations. Despite these efforts, many customers and investors remain skeptical about whether Wells Fargo can truly regain their trust. The bank will need to demonstrate a sustained commitment to ethical behavior and customer service in order to rebuild its brand and reputation. Lessons learned from Wells Fargo's scandals. The scandals at Wells Fargo serve as a cautionary tale about the consequences of prioritizing profits over integrity. The bank's aggressive sales culture and focus on meeting sales targets led to a pattern of unethical behavior that ultimately damaged the bank's reputation and financial performance. The scandals also highlight the need for strong leadership and a culture of ethical behavior within financial institutions. Banks and other financial institutions must prioritize the well-being of their customers and employees above their own profits, and must be held accountable for any unethical behavior. Finally, the scandals at Wells Fargo demonstrate the importance of transparency and accountability in the banking industry. Customers and investors must be able to trust that financial institutions are acting in their best interests, and regulators must have the tools and authority to hold banks accountable for any misconduct. Conclusion. The rise and fall of Wells Fargo is a cautionary tale about the consequences of unethical behavior in the banking industry. The bank's scandals have damaged its reputation and financial performance, and have raised concerns about the culture of greed and unethical behavior that can exist within financial institutions. However, the scandals have also led to important reforms and changes within the banking industry, and have sent a strong message that unethical behavior will not be tolerated. By learning from the mistakes of Wells Fargo and other financial institutions, we can work towards a more ethical and trustworthy banking industry that prioritizes the well-being of customers and employees above profits.